Thank you so much for tuning into The Journey with Christian Diamond's podcast, where we talk to amazing, amazing individuals doing really cool shit. And that's the reason why we have this next guest on. She's doing some really, really awesome stuff. Not only she is a renowned speaker and keynote speaker doing amazing, but she's also investing in some really, really cool tech, deep tech, B2B SaaS. And she is in the Silicon Valley ecosystem. So she knows what's going on before the rest of us do. That's the reason why we have this next guest on. She is the GP at Yellow Rocks VC. Please welcome Valerie Bertele. Valerie, how you doing?
Christian, thank you so much. So happy to be here, tuning in all the way from San Francisco. I'm actually right in Presidio, in the heart of, I think a lot of VCs are moving into this space outside of downtown. So I'm literally surrounded by Founders Fund and Headline as my neighbors here in Presidio.
I love it. I love it. You know, you have a lot of projects going on. And one of the things before we dive into investing and the way you think about this, you know, every day we have a choice to wake up, right? It either motivates us because we're working on some cool, passionate project, or it's like, oh gosh, another day, right? It's Monday, kind of thing. And I'm curious, Valerie, you have that energy and that vibrancy that you're just passionate about something, and that's the reason why you do what you do. What is that? What makes you tick? What's that thing that drives you?
I think there's two things. One is the classical Silicon Valley. If you know Huberman, he talks about high level of dopamine, and some people just have the higher dopamine by birth. I think I'm definitely a high dopamine person. I always had a lot of energy and drive to do things. But I think what motivates me to do what I do right now, I used to be a scientist. So I've started as a geeky child who loved technology. I was in biotech, I was in chemistry, doing genetics. And then I just realized that so many smart people that cannot talk to the business side. The commercialization is so hard, like go to market, it's so hard, like simply describing your idea outside of your laboratory and bring it to the world. That was like a very difficult task. And as a scientist who realized that I can talk, I can sell, I can speak, being an investor, being on the other side, I really want to give the voice to those founders who are struggling to get their company, to raise their money, and also to get that very first support to bring it to the society. So I think that's my big driver as a scientist turned venture capitalist, and pretty much in everything what I do.
You know, and what's interesting is you guys have a lot of different industries that you're focused on, from AI to fintech to ed tech and things like that. What have you noticing that is just so interesting? What I mean by that is, like, for example, we've invested into just recently a biotech company that's really pre-FDA, right? And the reason why we do that sometimes is because we believe in the possibility of the impact that it can have, right? So we're fine with taking that risk because we understand that once it pays off, not only is it a good investment for ourselves and the return, but also the impact that it's going to have in lives, right? And I just want to ask you, like, when you're investing, is it really like that impact lens where you look in and say, hey, look, we're going to deploy capital, or we're going to help incubate, or we're going to help work with these founding teams? Because at the end of the day, yes, it's a return. Yes, it's DPI for our investors and other LPs that are collaborating with us, but also is that impact.
I would say 100%. If you look at our thesis at Yellow Rocks, I mean, it's our second fund. Was the first fund we tried everything pretty much. Yes, returns is the goal, but it was always a value-driven investing. And I think the second fund, we pretty much crystallized what we're investing in. We're investing in future of education and future of work. So everything what we see in society right now, and AI is one of the tools. It's automation, cloud, cybersecurity. So what do we need to learn now to prepare for the future, and how the future is going to look like? Maybe we're not going to work. Maybe it's going to be UBI, right? Universal basic income, or maybe like there will be more healthcare issues, or like what is going to happen with the society. And I think fintech as the underlying base, it's still something that powers both education and future of work. And in fintech, even being in America, I moved here from Australia. So I lived in France, Australia, Belarus, China, like literally across the world. And I was surprised that still financial system in the US is still very conservative. Like I had to do wires pretty much manually, give a call, talk to human. I don't want to talk to humans. I want robots to do those wires. Like I'm as a human much more prone to mistake rather than like the automated system. So I think I see that fintech, education, and future of work are the big focus for our fund. And it's definitely, I mean, talk about education. Like whenever we invest in it's our children, it's our future. So it gives us this moral compass to where we want to put the money and which founders we want to support. So for sure, 100% with you on this, Christian.
So let me double click on the ed tech. So what I find so interesting, I look at it very similar to almost climate tech. And let me explain.
Yeah.
Climate tech, a lot of times you have to have like, government contracts or government relationships to, as kind of the catalyst. Same thing
Hmm.
with ed tech. Ed tech obviously is the educational aspect, educational system of some sort. So a lot of times that may be integrating with the public schools, different states, different school districts, et cetera. How do you think about that in regards to like one, the market penetration, but also like the the X amount of growth potential, right? Because there's only X amount of schools, there's only X amount of whatever, whatever. How, do you think of that as like, okay, it's a restriction on the potential
Are you
growth?
asking, is the market big enough for education? Is that your
Yeah,
question?
yeah,
Uh,
basically.
I hear you. I hear you. And education, I see education as not just like, yes, we have some companies that are working with the federal and state government. And yes, there's certain regulations. But I think the system is so archaic that there's like, once it's implemented from the one state and then moving into federal, there's definitely opportunities. What we're trying to find in our like ideal unicorns, think about Duolingo, right? It's a simple app for language learning. And as much as we like ChatGPT and other tools like instant translation, we still need to learn languages. I spend my weekend learning German because we have some business through the family office in Germany. And I realized that I need the language. I need to speak the language. I won't be able to negotiate at the table using, oh, ChatGPT, what exactly are they saying? So I need to have that conversation, right? And even having a translator right next to you, it still doesn't perceive well. So companies like Duolingo, it's not just US, it's not just states, not just federal, it's global. People need to learn languages. One of our companies uses avatars, right? It's not new, the idea to use avatars to teach kids languages and different skills. But the beauty of that, so it's a global company that can be scaling, and the founder is successfully signing contracts with the federal level to actually put it into the school education. So that's finding those both combinations, serving the need here in the US where we're based and where we're investing, and also having ease of scalability that you can just move it to any other country and scale it. That's education. And there are more and more companies like Grammarly, for example. It's not exactly education. I think it's productivity. As a non-native speaker, I use Grammarly from very beginning, like crafting emails and like sending, like just changing my spell check. It's so much better than ChatGPT because they focus on that one niche. Everything about writing, and Grammarly now is education. People use it for training. I think it's used for like curriculum, like marking the exams, and it's just fantastic. Like it's a cross section between future fork of future education. I think that's what I was talking about. It's not just education; it's moving into future fork. How we do things. Is it automation? Is it using the avatar? Is it more AI into processes? So I think it's always should be interlinked to give you a big enough market as if you're looking at from as an investment perspective.
So let me ask you in regards to the future of work and where the macro trend is. When
Yeah,
COVID was happening, obviously we saw Web3 and Web3 investments in general just
yeah.
drastically increase, partially because a lot of people thought we were just really headed that direction. Everything was going to be online, et cetera, for the rest of our lives. Things didn't work out that way. And so I'm curious, obviously looking at not only just trendy topics, like trendy investments, but also acknowledging the massive market trend holistically when you're underwriting these deals. I'd love for you to walk us through that, and kind of give me an idea of where you're at and what you're seeing right now in regards to the future of work.
Globally, I actually have this magazine right in front of me, and I think I told you about this. It's called Foreign Policy. I started reading it a couple of years ago because I was just curious, like what's America, like how America is overseeing the world. Because I moved from Asia. I spent 10 years in Asia, China, and Australia. And one of the articles it talks about, let me just find it. It was super interesting. It's the age of depopulation. So on this level, like I read 5 years ago the book which is called "The End of the World is Just the Beginning." It's a pretty fun and catchy title. I thought, oh, maybe it's some populistic bullshit, but it was actually a really meaningful book that talked about. I think the first chapter it was like compressed Yuval Harari, if you know the Sapien, like really compressed what's happened with the world, and then he dives deeper into population, like, and he talks about that the population will go down significantly. It was like almost 6 years ago, and now we have it as a foreign policy that this is the big issue, right? So having your mind and a radar on those really high topics will help you to think like what is happening with the society, right? COVID was a big hit, and honestly nobody could predict it when it will start and how it will unfold. Everybody was panicking, but I was looking for the underappreciated assets. That was like my strategy there, which worked out really well. But I think long-term investing, it's being curious, reading literally, like, I think policy and politics, economics is so important to see on a higher level. Like, let's say depopulation, we will have less people. So how do we address that in education? Maybe it's going to be education not for younger people, but maybe it's education actually for elderly people who are aging, and we have a huge disproportionate number of people who maybe need to support themselves. Maybe they need to retrain and learn new skills. So maybe it's going to be education for a second half of the society versus just thinking about children, right? So something like that, the foreign policy, I just love it. It gives me this really deep like glimpse on where to invest the next couple of years.
Let me also ask you this because I've talked to a few of my Dubai family
Mhm.
office friends, and
Yeah.
what's interesting is that their position and their strategy is very simple. They take and they look at identify developed working products and services in the US, and then they like to basically create it over there in that UAE Dubai region. And so
Hmm.
they are the bridge, right? And they invest into it and of course create
Yeah.
that whatever. You mentioned, of course, ed tech and other things, and you guys do invest into a lot of different areas like Brazil, U.S., of course, U.K., Switzerland. I'm reading this off your website, Israel, India, Singapore, etc. The reason why I'm saying that is because let's take U.S. outside of the box. Every
Hmm.
other of those nations, like India and Philippines, etc., that's a huge population, right? So I'm curious because when we're looking at these opportunities, right, and investing our time, energy, and effort, when you're looking at that, is there a risk tolerance where you're saying, okay, look, we see some of these emerging markets like the Philippines and Singapore, et cetera, where we're going to take a small exposure, right? Maybe 2, 3% of our portfolio, we're going to have invested into that. Or is it saying, look, we're going to be opportunistic and we're going to be able to say, we're going to deploy capital in these things because overall, if you extrapolate this out long enough, we're going to see a huge, huge amount of volume. How do you think about that?
It's a really good question, and I just wanted to actually clarify on our website. Yes, we have a map with the different countries. We try to invest mostly in the US because we understand this market, and it's also de-risking in a way because as much as politics is turbulent, we still understand where US is going, and it's a stable market, right? We have a few companies outside of the US, notably we have Philippines, we have Brazil, because we found some interesting intersect, and mostly we're looking into repeatable founders. So, for example, founder in Brazil, it's a pretty cool story. The lead came to us from World Bank, pretty much, and the lead was the founder was in MIT. He was studying in the US, and then because he was originally from Brazil, he saw the untapped opportunity combining fintech and agriculture. So they're providing loans and the servicing in the fintech level to all the agriculture that's happening and booming in the Brazil. So for us, we know that the market is happening, but I wouldn't say that I can go to India and just be the better than people who are been there for many, many years. There's definitely risk involved. So for us, we're taking those, I would say, a lighthouse project or lighthouse founders who can give us the light. Maybe they're originally from there or they have a strong connections to succeed in that particular market. So the founder in Brazil, the company is actually in Delaware. It's incorporated in the US, but they have a majority of customers and the revenue coming from Brazil because of that MIT Brazilian connection. And similar with the Philippine founder who is working there, he first of all very experienced. He sold 2 of his previous companies, so we knew whenever he put his mind into, he will be successful. So it's mostly following. It's like an artist, right? Like once you choose a piece of art, you either really love the art, so it doesn't matter like whatever you buy, but it's not really investment. It's more like your enjoyment, or if you know the artist and they produce some significant work, you know that they figured it out. It's similar with founders. So we try to focus on experienced artists who've done this before. And it's a UK company. It's a similar. It's a repeatable founder. They sold previous company for 500 million. So that company in the UK is doing really well, and they're growing into Australia, which is a Commonwealth, Canada, and then potentially US. So taking actually different routes. We love the founders who are not just like, we're going to go into the US and going to compete directly. How about the rest of the world? I will give you a good example. I have a good friend of mine. He's a founder of InDriver, which is InDrive. It's the third largest ride sharing company. It's a unicorn after Uber and Lyft, I think. Nobody heard about them in the US, but they are the biggest in the emerging markets. So what they've done, they smartly went around and captured the rest of the world. And now they can come to the US and compete being a unicorn versus trying to fight with Uber here directly. So it's creative. I love it. And living around the world, they are big markets. They are huge emerging markets. They are riskier. So you have to have a certain advantage or like the founder or the connection to win on that market. Otherwise, I mean, India is great. I have a lot of classmates from Stanford come to India, invest with India, and I love it. It's a wonderful market. It's booming, but I have no understanding what's going on there. I cannot win, so I'm not going to stretch too thin to go there.
I want to double click on the concept because a lot of our listeners are investors and they
Yeah.
mainly focus on, I think we talked about this offline, mostly US deals, right?
Mm-hmm.
And we've invested most of it because it's just protected. We know we're familiar with this legally, all that stuff. You mentioned something where you don't invest into a like Brazil or UK without some sort of competitive advantage. And so I
Yes.
want to ask you a little bit more about obviously, like you just said, one, are they high conviction, exited founders before? Yes, cool, wonderful. Is there a competitive advantage in regards to maybe their market, whatever that they're going for, and then their strategy? Are there any other things that you're doing to mitigate that risk, whether
Huge.
structurally, when you're deploying, are you deploying into a fund or are you deploying it directly into the cap as the cap table into that company, or what other structures you're doing? Maybe a debt to equity to again mitigate your risk.
Okay.
I'm curious what's your how
I
you're
think I
structured.
will give you an answer not just as a venture capitalist. I will give you an answer as a family office, as an investor, right? Like once you have a pool of money, if you look at the statistics, venture capital, it's actually, I think, less than 5%. So it's a tiny, tiny proportion of an overall portfolio. And yes, it is risky. So you have to understand from the very beginning that venture capital is a risky asset. That's why it's called venture. So like looking at the like a family office perspective, there's of course bigger portion of real estate, stock markets, bonds. You optimize to actually mitigate this risk and to don't lose your money. So as a venture capitalist, for me, I have my riskier bet outside of the fund, which is my angel checks, where I try to either have some exactly what was shared, like competitive advantage. I came from healthcare life science. A lot of my postdoc and my PhD friends are now professors and they're running really interesting projects like in Harvard, Stanford. So I know them, who they are, and if they will be succeeding. So for me, it's de-risking, like knowing those people in a super early stage and risky markets. Then with the fund, because I'm managing others people's money, the risk tolerance is very different. So for example, we don't invest in healthcare, we don't do hardware, like anything that is very long term and actually dependent on outside factors like FDA approval. Like I've invested in stem cells early on, right? And I made some money and I lost some money. So they're risky. I know that. I've just been fortunate to be very early starting in genetics in 2006, a while back, right? So I've seen this whole way for almost 20 years. So angel checks is my own risk, right? The portfolio, I'm de-risking it and making sure we have good returns for our LPs. And then also on the later stages, what I do personally and what we do with the fund as well, not with the fund, with the family office, I will join some deals either as a syndicate or sometimes I take only equity and help them as an advisor without investing my own money. So for me, I don't risk the money. I just risk my time and my connection, but I want to be part of those deals. So I usually trade equity for versus cash, right? So it really depends on which stage you're working on. Some deals on later stage maybe don't really need your money, like Perplexity, for example. Like they have millions of dollars and huge backers. Like as a smaller family office, you cannot compete with that. But maybe you can own some equity by providing unique access or market strategy, or maybe that potential customer that will benefit them more than money. So it's actually being strategic from very early on to late stage. That's how I see venture. But still, venture is a risky asset. We have to all understand that.
Mhm. Yeah, and that's a general blanket statement, but I love what you said there, and I think it's really important for us to
Mhm.
understand how you're mitigating that risk. One,
Yeah.
you have deep conviction, obviously, with the founder themselves. They've exited before, but also there are certain things structurally that you do, whether you're an advisor and you're taking sweat equity of some sort, adding resources or time or energy and effort to direct that company, but also just acknowledging that you may say, like for example, I was looking at one deal, and we were gonna basically the term was saying, okay, we'll do 2 million now, but
Yeah.
after a certain point, certain hurdles, then we'll go ahead and deploy another 2 million. And that again helped us. And even that with the 2 million was a convertible note, a 10% annum. So we knew at like a value cap of like 80 million. So we knew that okay, hey, there were certain things that were needed to happen. And again, we weren't deploying too much, but obviously some success was happening. I was
Yeah.
curious with like Yellow's, with your venture capital firm, what is your guys' approach when you guys are defending your position in regards to follow-on checks and things like
Mhm,
that?
mhm. It's actually a really good point, and I also wanted to add to your previous one. How do we de-risk our investments, even through the fund? Like fund is just easy because it's more structured. First of all, I mean, we always want to negotiate pro rata. This is like the basic thing, right? But at the same time, we also demand a really full transparency. So we talk to founders regularly. We actually have a chat where we connect all the founders, where they help each other, because maybe somebody's a later stage and they figured out something and they can just share with the other company. So we really build this really nice community helping each other, like hiring, solving, let's say, marketing strategy. So, and also once we have that good relationship with the founders, we also, I mean, I would say we demand transparency. We always ask, tell us if there are problems. Like, as an investor, we're going to help you. We're not going to penalize you. We already gave you the money. Just help us not to lose our money and help us to not, for you not to lose your business, right? So every month we have a regular sync ups. We ask them for all the details, materials, like where they're growing, what are the must-haves, like what do they need from us, what help, or maybe like what's going wrong, and we will just prepare. So maybe in the next couple of months they need more money because they didn't expand to burn so much on marketing or engineering. So it's relationship, transparency, and also accountability. Of course, we had bad players. There's some companies who just like hiding or like, faking the numbers. So we try to be friendly as much as possible, but then at the end of the day, we have to press them and say, hey, we have to see what's going on. If everything is going down the drain, just tell us. We at least will try to sell the company or sell the asset. So we're both like ending up with something, right? So it goes down to relationship from the very beginning to a successful exit. If you have good relationship, the founder that's going to exit, they will potentially come to you as an LP and they will give you money to manage, or they will just say, hey, how about I will help you? I will bring the more, like they will generate leads for you so we can invest together. So I believe in trust and respect in any business I do, and also transparency and friendship. Like, try to invest in people who you genuinely like and want to spend time with. And usually
Mhm.
it works as a good model.
You said like obviously mitigating selling, mitigating risk and
Yeah.
selling. Are you selling it on the secondary market, depending upon where that company may be? If you're looking to go ahead and take some DPI or take some money off the table, or
We
you're
we
like, hey, I
haven't
don't want
we haven't had it yet with the
to.
current
Okay.
fund, but we have some offers. We have some offers. Companies want to buy it, like buy our portfolio, like buy our secondaries. It's either secondaries or sometimes the company wants to be bought by the bigger player. So we're all going to have liquidity because they're exiting or merging. So we are carefully considering if it makes sense, because you don't want to be too greedy. I mean, I had this experience previously. Companies growing so well, and you have a sale offer, and you're like, you never know, right? But if you feel that the timing is right and you have a good multiplier, like one of the offers that we sold recently, it was from a first fund. I think it was like 12x. And come on, it's a good return. So we couldn't do better with this company. So we decided to sell our share and just focus on other investments, because there was a bigger player who just wanted to clean up the cap table. So that happens with the early stage, because we sometimes come really early. Together with Yellow Rocks, we also have Pre-Seed to Succeed, which is an early accelerator where we give $50,000 check together with four players. We're four funds together. So it's from 50 to 200 if all partners decided to join. So we have kind of a seeder where we seed early stage. And then once they graduate, we'll put them in our fund. And talking about pro rata and giving them money later, very often, if we still can, because once you have a big famous funds on a later stage, some founders like, oh, we don't need you anymore. But because we have good relationship, we usually open private syndicates within our LPs to allow to add money to those winners that are growing to the next stage. So this happens successfully, and we've definitely done it. So yeah, this is for us flexibility to our LPs, and also for us in a way de-risking, because we know we have those pools of capital, even if it's outside of the.
Yeah, that makes sense. So on your winners, let's say, for example, you decide to run an SPV to
Yeah.
obviously have high conviction for it, and then pull other LPs into that. With that specifically, is that tend to be on their like Series A, Series B kind of primary round, or is that also a secondary SPV transaction?
It's more later rounds. Sometimes we see secondaries. I mean, like once you get older, like once the company is maturing, there will be more and more secondaries, because those. I lost you. Christian, I lost you for a sec.
Go ahead. I'm sorry. Go ahead.
So I was telling you, once the companies are maturing and getting into later stage, you will see more and more secondary. So this is definitely happening. once the portfolio is maturing. And it's people like to clean up the cap table. I think the bigger players, if you go to private equity, I mean, it's more like super late stage. People want to have less players on the cap table. I've seen some, wouldn't give the name, but I've seen a unicorn who recently became a unicorn. They had 700 investors on their cap table. And there's a one big private equity / venture capital who came and backed them up to become a unicorn, the latest like big round before the IPO. And it was a huge work. They spent like 6 months and a lot of lawyers just to clean up the cap table, to buy those secondaries and make it more clear and transparent, because you cannot have 700 people on the board once it's also getting public. So I think it's more down the line. I would say 80% just supporting later raises versus 20% secondaries.
I have seen where, we've invested into this B2B SaaS later stage fund, relatively small. And what was interesting is that they had another SPV and they were like high convicted. We decided to pass on that specific SPV. But I asked the founder, the GP there, I said, how's the company going? And what's interesting is that they've held that company for almost 7 years. They normally would like to exit at roughly around that time period. They basically had a conversation with their LPs and say, hey, look, we can exit this and we'll, obviously get some liquidity and good DPI, or we anticipate and we expect it to go even higher so we can roll over what we have. But what was so interesting about that approach, the reason why I say this, is they had a really honest dialogue and communication with their LPs and said, hey, if you guys have patient capital, if you guys don't need liquidity right now, might as well go ahead and get an extra 3 or 4, X on that multiple of what it is currently. You know what I mean? And so I found that very unique. I'm curious because in today's world, yes, a lot of investors are looking for liquidity, right? They've been holding some of these assets for a long, long time. The IPO market, I'm not saying anything anybody doesn't know. They understand this. But I'm curious, I am seeing a huge trend in a little bit more of patient capital structures as well, saying, hey, look, at the end of the day, we want alpha generated and we really don't need liquidity. How are you seeing that market? Are you seeing where they're fine with being able to be illiquid for longer periods of time? Because obviously there's a lot of alpha that can be generated. Or are you seeing, again, that typical 5-7 year period and a lot of angry LPs, if you will?
There are angry LPs. I mean, not angry, but people who are more, because the market was, if you look at stock market, I also do stock market investing. It's been doing really well. People are like, why didn't I put my money in NVIDIA and have 600%? I think now it's 700%, or crypto, right? And I have to wait for those returns on the venture. So you have to understand it's psychology. It's very psychological. Who are you working with? I had examples. For example, one of our LPs, he said he will be committing into one of our SPVs to support a later stage. And then he just say, I'm not transferring. And normally I would get upset, like, oh, something is happening, he's backing out. And I just was very gentle because I know him well. He's a great investor. He's a great LP and a good friend. And I say, would you mind just giving me a little bit more transparency? Is it the deal you decided not to support, or maybe something happening on your liquidity? And there was a total silence for a couple of days. And then he's forwarding me email that he invested in some big stock pre-IPO market, that he just made this money really quickly. And he's like, hey, I just needed this chunk right here. I turned around. And a month later, I put my own money, like, to support that like in our fund. And he brought this money back. So it's give you an example of somebody who's like, hey, I'm a little bit greedy. I want to turn it around. Just transparency. So by me not getting like angry at him and just asking, like, would you share, like, what's your logic, right? It's not like he didn't like our deal. It's just like he had somebody else to quickly turn the money. And also, I also like to, when I talk about fundraising, and sometimes I teach those workshops. I did one in London and San Francisco, because I feel demystifying the process from the VC perspective will help a lot of founders to understand how the system works. And also, like, we're both going to benefit from this experience. I always say that family offices are the best investors, because if you're fundraising from institutional funds, endowments, anything that more like a bank, like, they will be more pushing returns because they also have their KPIs. But family offices, it's their own money. So they can wait a little bit longer, exactly for the patience investing, what you said. So if I'm doing deep tech, I like to have family offices, or also older and more mature VC funds like Axel, for example, somebody who've been around for a long time. They have plenty of money. They're not rushing to get a new round, and they can wait. They understand that some big technologies will take time, like genetics. from 2006 when they done the first human genome sequencing to now we have so many companies and everything is basically run by that discovery. So it takes sometimes a really long cycle to commercialize and to have this alpha. So family offices, if they're more mature in the mindset, they will have flexibility to wait and to also provide more capital, maybe like in a more emergency situation when you need their support. So I believe that that's the best category to work with as an investors, and we have plenty of those in our portfolio.
Yeah, and I also see a lot of individuals, a lot of family office friends of mine that decided to go the credit route because that whole situation
Yeah.
with the macro trend. They say, hey, look, we're tied up for two years. It's a 12, 13% return on their money, and they're fine with it, and that's they're not looking for the big alpha, and they're continuous, and they can pull it and put it into something else. It's very unique. I'm curious. I want to ask you this because you were mentioning something that kind of reminded me of it.
Mhm.
Risk reward ratio, right? A lot of people, I've had this conversation previously. Some say, hey, the higher the risk, the bigger the reward. That's not always the case, right? And then part two of that question is hedging your bet, right? I'm I'm a big believer in high conviction into a company or whatever, but also I think you do need to hedge your bet and maybe another founder, another company, maybe they're targeting the same individuals, maybe they almost have the same product and service, but it's like, hey, look,
Mm.
I'm going to hedge my bet because I know one of them's going to win. I don't know which one, right? It's like
So
this.
you mean like you invest in kind of competitors, like in the space, to see who is going to win?
Yeah, correct. It's like investing into the Nvidia, investing into Meta, into Google, because at the end of the day, they're all competing in
Yeah.
the AI space. I don't know who's going to win.
Exactly. And I mean, I think it's a little bit different public market versus private. So yes, public market, of course, we have a diversified portfolio, right? Like you want to see who's going to win because they're all the winners. Like having all three clouds, I used to work with Google Cloud before, they all have their space. It's not like one is going to lose. They just have different market shares and how they operate and how they work. I think with startups, and actually it's very interesting. I spoke recently with the company who invested in OpenAI, and Sam Altman was closely pushing to do not invest in our competitors. Like if you're backing up an AI, you cannot back Perplexity or I don't know, or other players. Like we start seeing it like recently in Silicon Valley, it's in the private conversations, but because those large language models, they need so much capital. By providing both winners with like a large sum of capital, we kind of advancing both of them. So we're seeing that trend in Silicon Valley, which is really interesting. Like founders like do not invest in our competitors. We would not like it. We will like it's almost like they want to put it in the contract. If you're investing in us, you cannot invest in competitor, which I don't agree 100%. I also think if you invest in, like as you said, like let's say two companies, because they're both strong, especially later stage, they're both growing, there will be an M&A. It's either they're going to merge or somebody will buy somebody because they have the market share and they have the technology and they have the talent. The biggest thing people don't talk about is the talent. It's so hard to find good engineers, to train them, and also being in this unique, especially if it's a novel space, they're not going to die. Like somebody will get those engineers. It's going to be either acqui-hire, like people just get the people, or it will be M&A, or it will be a merger. So I think it's strategically very smart to hedge your bets and have them in a both winners, especially if they're kind of okay with that.
Speaking of talent, so this is unique because I've had conversations with some of our portfolio, and what is
Hmm.
interesting is I'm curious for your take on this, Valerie. When you're having these
Yeah.
conversations, you and I know to acquire the best talent. I would just like, for example, XAI and OpenAI, right? They are spending millions upon millions of dollars to get the best engineers on AI. I mean, millions plus stock options, plus this, plus that, right? All these bonuses and crazy. I mean, they're just throwing money at these
Right.
individuals. I'm curious the way you think about it with these startups. They don't have the capital. If they do, they need to raise a ton, and their burn is like super high on the operational aspect. And is that effective? Or how do you find the right talent, the best talent for a startup, right? That's pre-revenue. That's maybe just even a million, 2 million top line, whatever it is, but also structure that opportunity where they may get vested equity. I'm just curious because I know I've just seen where some founders are really good at it. They can attract the right talent, but it's all about the vision, it's the goal, and they get excited, and people want to, follow that leader. And some, it's like, well, we can't we can't pay you like Google pays you. We can't pay you like XAI pays you, right? So I'm curious, how you think about it or have those conversations with those founders to bring in the best talent.
Whenever I told you we have a group of our founders, right? Like they're all together in the chat. And the biggest request, the biggest we always have, outside of course, helping with connections, fundraising, networking, it's the people. Everybody's looking for engineers. It's such a huge, I would say, problem, demand, and especially because we're investing in early stage, people who you hire, they are critical. Let's say your first or second engineer, if everything works well, it's going to be your CTO or second after CTO, right? It's the critical people. And it's not just the skills, it's the culture, it's the morale, somebody who's going to stay with you for a long run. So it's definitely a really difficult question. I think a couple of years ago, it's somewhere on internet, I was interviewing a pretty famous person, also not giving his name because it's like want to keep his privacy. So he joined Microsoft, Tesla, and then one healthcare life science company, and he's built the cultures for them. And he gave me like a 7 points what are the most important. So you have to find people who are motivated by your vision, because you cannot compete like with Google. Like a regular salary, it's like 300,000, like for okay engineer. Good engineer makes 500,000 easily, and then there's stocks and bonuses and everything on top. Why would you work for this crappy startup very often for like little or no money? You can just, as a good engineer, you go and join Google Meta. Now everybody's like crazy trying to get people back. So it's definitely about the vision. It's aligning with like, we're going to be together in that. And I think for an investor as well, it's really important to see that people are not just there for the pay, or that they love the company, they want to work for it. And I think for us as well, talking about the burn, it used to be okay a couple of years ago, because I've started in venture quite back, that, you know, you're burning so much money because you have engineers in Silicon Valley. It's not a norm anymore. You have to justify, why do you have to hire people? Why do you have to pay that super expensive person from Meta that you couldn't negotiate better, giving them more stock and a little bit less of a salary? So you want to show that you have reasonable burn. Like one of the examples of one of our portfolio companies, they moved to Tulsa, Oklahoma, like really outside of Silicon Valley, because one of the investors offered them free housing, free office. And they say, like, you know, it makes sense. We just need to go there. We need to go and build. And with 7 people, they built like several millions of revenue, just being out there and not burning money on, like, housing is expensive. Like, talking about salaries, living in San Francisco, in Silicon Valley, it's very expensive. And another point, which is really important, when I moved here to Silicon Valley, it was 2019. So I literally caught that wave of COVID, and I was with Google Cloud. Google started hiring people on offshore locations. Of course, India and Eastern Europe were always there, but Latin America became a huge area because it's the same time zone, the same culture, and just a fraction of cost. So I was at Google, and I've seen thousands of engineers being hired and also moving into like more work into Latin America. If you've seen in my LinkedIn, I'm working right now with Virus Dev, phenomenal company. I met the founder actually 6 years ago. And company was like maybe like 300 of engineers, small, but really interesting. He said, I'm going to focus only on senior people, like really get the right builders. And now the company is 5,000 people. So what I do, I bring those engineers into my portfolio companies, because that's exactly what we need. We always need, once you raise more money, the first thing you're going to hire, it's more people, either engineers or sales or support. It's always about people. So scaling is people. And having the right partnership with a venture, I think it's actually a new model. Like, what are you going to provide outside of money? Is it connections? It's almost like not enough. Everybody has connections. You have to give, is it engineers you're going to help with? Is it marketing? Is it PR? Is it go-to-market? Something beyond that just the initial chunk of money. And it also helps us to win deals with the hot startups, because sometimes I'm competing with Microsoft, I'm competing with Headline. Like, why would they take Yellow Rocks? We're much smaller and less famous fund. So we bring something else, and we convince founders that we are a good partners. We're actually going to roll our sleeves and work for them. Microsoft probably would. I love Microsoft team, nothing against them. But I'm just saying, bigger funds, here's the money, here's the name, go figure it out. They very often, you're just tiny little startup and they're huge portfolios. But for us being a private and smaller fund, we will actually work with them. I will personally meet with them for coffee. Like, I'm putting right now a few PR campaigns, like getting them speaking opportunities into big conferences, because I care, and I can do that with a smaller fund.
Hmm. And I think you're spot on. I've seen a lot of startups where they're able to keep their burn drastically down because they're able to get international expertise, and we're seeing the talent in Latin America and India and others, sometimes the same or even better than U.S. talent. It's
Yep.
actually very interesting for
Yeah.
like pennies on the dollar. And so, I mean, it makes perfect sense. I wanted to ask you on the
Exactly.
talent aspect. So Silicon Valley is known for this, where some of the biggest names came from there within the last 10, 11 years, partially because it's like this incubator of just this amazing environment, and everybody's like just hustling, kicking butt, and they're like in the office, they're doing it together, right? And there's this energy. There's a lot of
Yeah.
tests on this where even sales environments, right? You can't really have a really remote sales environment. Yes, it works, but there's something about this amazing synergy that when you have a sales department all together, kicking butt in the same area and going to work in like an office, there's something about that that's just like there's, high fives, whatever, right? There's something about that energy, and it levels up everybody. What is your perspective on when you're working with a team or founding team and you see that most of the um, the team are remote? There's obviously an amazing opportunity with that, but also there could be a downside where maybe they're not maximizing their full
Yeah.
synergistic ability because they're not all at one location. What is your perspective? I've seen and I've heard different things, and is there any data behind it, or is it more just speculation, opinions?
I think two things. First of all, about Silicon Valley, it is definitely a unique place. And I would say if you're just starting, if you're in the beginning and you're raising money, it's so much easier once you're here. Once you come to Silicon Valley, things will just happen. It's not just the meetings that you set up. You go into events. We had a tech week, right? Thousands of events, thousands. You literally bumped into founders. You bumped into people are very helpful here. I think like the huge difference compared to anywhere else in the world, people genuinely like, hey, I will connect you. I will help you. And it's just like people do that. Like I was shocked when I arrived here from Australia, and I was thinking to build a new healthcare meetup. And I literally showed up into biggest existing healthcare meetup to a founder, and I say, "Hey, I'm new. I'm from this place. I'm planning to build pretty much your competitor." And he's like, "Awesome! Like super cool. Like, what are you planning to focus on? Like, we can team up. I would love to see what you're building." And he connected me to core people like within like a couple of days. I was like, "Wow, this is shocking." Like this is literally was shocking, and this is still my very first impression of Silicon Valley. It was literally 2019. Everything was like full on, and I was like, wow, this is definitely a unique place. So I think if you're just starting to come here for some time, couple of weeks, couple of months, get the people, get the investing, get this energy, even like like restart like what you're ever doing. If you're anywhere in the world, just come here and kind of learn the engine, how everything works, and then you can go into more like remote location or like something cheaper, which is totally understandable. But I think the beginning is really important. I know Austin is trying to create something similar. Paris is trying to be like that. I know in China and Shenzhen, it's a big hardware cap. But there's something in the air of California that people are really love helping each other. Plus, there's non-compete cannot be enforced in California, so people move easily between companies, which is a big part as well. So to answer your question, what is better, remote or teams together? It's a hard question. I've seen successful cases in both. I would say the more founders or more engineers are experienced, they can easily work remotely because they know the game. Like they don't need to like how to say they don't need somebody to like high five them to be productive because they know the energy. Like I think it's for more senior people and more experienced founders. If you're early on, if you're just starting, like especially like trying to click this culture, I think it's super important to get together, especially if it's like a core team, 2, 3, 4, 5 people. Let's say engineer, co-founders, marketing, sales. You need to kind of like brew in this juice to understand how you work, how you interact, even like the micro dynamics. Let's say maybe your head of sales is a little bit more a personality is more dominant, right? And engineers are just it's a stereotype, like a little bit more timid, right? But you know that they didn't mean anything bad. It's just the tech personality. And if you see a comment in Slack, you're not going to get offended or upset, which is, oh, this is how they are. But I know they're good people in reality. So learning the psychology of each other's team, I think it's super important to be together. I don't know any startup that started remotely and fully executed remotely from the beginning to an end. It's almost, I think, would be a miracle. Maybe we will see more of that, but I think human factor, nobody changed it yet.
Yeah, you're right. And there's something about this concept of being all in the same area and you're just pushing yourself at a different level than, let's say, for example,
Yep.
remote. And I totally agree. Definitely at the early stages from 0 to 1. Now, 1 to 10, that's a total different kind of conversation. But 0 to 1, you got to do that hustle. I want to ask you this also. So this is what I find unique about, um, you know, so each business industry is drastically different. So like the B2B industry or the SaaS industry in
Yeah.
general, it's like, hey, look, raise capital, burn the crap out of it, get market, penetration, and then now all of a sudden you can get like profitability, et cetera, and margins and all that fun stuff. There are, like you mentioned as well, you guys don't invest into like a very capital intensive businesses, but those are
Yeah.
very similar. Obviously with chips and all those things, right? In AI,
Oh
there's
yeah,
there's there's a lot that's very capital intensive, and you may not hit
yeah,
profitability for a period of time. How do you think about the concept? Because we are in a different environment now, right? Where you can't burn as much as before because you can't always
yeah,
expect that you're going to hit another, bridge round, or you're going to be able to raise another
yeah.
$40 million, right? It's just different right now. So how do you think about the concept of, okay, look, burn at all costs and grow at all costs, to, hey, look, let's go ahead and be operationally efficient with the money that we have? um, how do you think about that and working with your founders?
Pretty difficult question. I would say the market in general and investors became more, they demand more in a way. You cannot just burn like you burn like on engineers or marketing. It's the money became a little bit more strict. And look at the interest rate, right? It's a very simple correlation. The cheaper the money, the more of them in the market. Now interest rate is very high. People just, there's not that much cash lying around to throw, and okay, just go and burn and take this market. So investors are more, there's more scrutiny in the numbers, and I think for us as well, we want to see the numbers. That's the first thing. If founder talks about the vision, it's great, but you need to show me the numbers, like how are you exactly going to make it. But at the same time, you're right that there's some super capital intensive areas, and I was in healthcare before, which is one of the biggest, like the research, the R&D. My PhD, like I was working with the genetically modified mice. Every mice would cost you like $5,000, just one mice, and you need like hundreds of them. So you cannot just start it from your laptop, like doing a drug discovery. You need to invest heavily in that. And I think that's one of the reasons, for example, with Yellow Rocks, we don't do, as I told you, hardware and healthcare for exactly the same reason, because they are very capital intensive. We are a smaller fund. We are investing in a software that's easily to be scaled. People who are investing in SpaceX is another example, or Tesla, they burned so much money. I don't even know if they're still profitable. I mean, with the new releases, it's still like huge burn. So yes, you need it, but you have to understand, like as an investor, which space are you going to play with? I would say in general, the more money you have, the more you can burn. But at the end of the day, if it doesn't make sense, even if it's a software company, we want to, like, I always ask a question. Fantastic, you're raising this money. What are you going to spend it on? And if people are not concrete and they cannot show me why they need to burn so much on marketing versus engineering or building a product, I have concerns. So I want to see clear understanding. If it's the beginning, you need to burn more on the product. You need to invest more in engineering, building, MVP testing. Later on, if everything is ready and you found that product market fit, that it makes more sense that you have to go against competitor, or you want to go and blast the marketing to get that market share. So it all should make logic, not like always engineers, like it should be very concrete, like why does it make sense on this stage for you to burn that much money, right? And then we will support you. We do breach rounds. Sometimes things get tough, and yes, there's no IPOs, there's less liquidity, and the market been really tough last couple of years. So being a good investor and having this transparent relationship, when founder comes to you and say, hey, I'm actually burning like a little bit earlier than I expected because we're expanding or because something happened, we need this money to support, and we will try to support them in the bridge round as much as we can.
Hmm. When you're talking about fundraising, there are certain metrics when we're underwriting a company, definitely
Mhm,
at the early stage or even later stage. We like to see like some, obviously, what's their burn, of course, but also what's their runway? How much money do they have in the
mhm,
bank? And because that helps me understand. Okay, I was literally talking to a friend of mine, and he brought me a
mhm.
deal, and I was looking at their metrics, and they only had like 3 months or 4 months of runway. And I'm thinking, oh, that's kind of
Yeah,
scary. Their burn was drastically high. It shows to me that that founder is not able to make the tough decisions to be able to say, okay, well, we got to either figure out marketing, product market fit, or two, we got to decrease the amount of employees that we have. And that's the tough situation to be in. But they were basically raising this bridge round just to be able to keep the same team members on. And
okay.
that's worrisome because it's not they're spending some of the money back into market and sales, right, to potentially acquire new customers so we get revenue. It's just basically spending money just to keep things afloat. And that's worrisome.
And what would you recommend? Would you recommend to fire people, to downsize the team?
Well, that or you have to put the money back into marketing and sales. But I mean, at the end of the day, if you don't have like product market fit, you got to be, if you want to, and that's a tough situation, you've got to be able to have a transparent conversation with some of your team and say, hey, look,
Yeah.
our burn is this. If I got to get rid of some of you, because if I don't get rid of some of you, then all of us are dead. You know what I mean? So I think that's really
Yeah,
the,
I mean, it's a tough decision. I agree with you. It's a tough decision, right? And especially if you build this A team and everybody's working, but you're not there yet on profitability, or at least in some revenue or marketing. Yes, it's tough. And I've seen founders, downsizing teams, especially I would say it's a later stage when it's a little bit bigger. I've seen founders in a critical situation, they will downsize a little bit, or at least put some people on sabbatical, like, so not losing them, but just say, hey, we need to survive this couple of months, right? Like, because you have to, like, I mean, it's scary if you see burn in 3 to 4 months. I'm like, what are you thinking? Like, you have to have a good reason to kind of even raising now. You know what's interesting about fundraising, what I see right now, I wanted to mention it previously. One of our founders, he raised 3 million as a round venture money, and then he went to the bank and he got another 2 million kind of as a collateral on that venture, like saying, hey, I have a like backing like investor, and they have revenue already. But yeah, it's combining venture with a regular debt, which I think was super smart. And this debt will be used later. So like right now they're gonna use the venture money, and then later, once they've done, they will use the bank's money. So I think like being smart about where do you get money, how do you get money, it's really important in this current market. Things are changing and things are different. It's not how it used to be before.
yeah. And that's,
So, but it's yeah,
That's how you identify the best winners, though. That's how you identify the best founders and stuff like that, right? It's how
right,
do they
right.
adapt to the markets, Valerie, I really appreciate being on here and just sharing your thoughts on this because we have to have you on again because everything's changing like every 6 months. It's just crazy to see that. And yeah. Now, for those that want to reach out to you, connect with you, have a conversation with you, how do they reach out to you, Valerie?
I'm a Silicon Valley on LinkedIn. I post a lot there, so please, you can just reach out to me there. I'm very responsive on LinkedIn. I don't do X that much or Twitter. I don't have time. Like, I seriously don't understand how people can post there so much. So LinkedIn is the best one. And also, if you're a founder, I would recommend to literally go and apply either on Yellow Rocks or Proceed to Succeed. Depends if you're later stage or accelerator. And once you're applying as a startup, because we have so much automation built up in our existing team, just put my name there in a note and your deck will directly go to my team. And then once you're still pinging me in social media, my team already will start reviewing it. So for me, it just totally makes sense on an operational perspective. So please do apply through online if you have a deck and ready to raise. If you just want to connect and chat, I think LinkedIn is the best. I do have an email, but it's I think it's clogged up. So LinkedIn is something I do daily. So please, yeah, do reach out there.
Awesome. And make it simple, I put all those links down in the description. That's yellowrocks.vc, by the way. So I'll put all those links down in the description, make it easy and
Thank you.
simple. Valerie, I really appreciate you being on here and just sharing the incredible knowledge. Like I said, we'll have to have you on again because everything's changing and it's always fun to have another investor, underwriting and doing due diligence on each one of these things. And it's a cool conversation. Guys, that is my friend, the general partner, and she also runs her own single family office at yellowrocks.vc. Valerie Bertele. Guys, until next time, be uncommon if you can.
Thank you.